Hi, this is Matthew Cratter from Trader University, and today I want to talk about how rich people avoid paying taxes and how you can avoid paying taxes as well. If you're interested in learning more about how the stock market works, how to make money in bull, bear markets, and also just want to see what I'm investing in or trading, be sure to hit that subscribe button. So a few quick disclaimers before we get started. I'm not a Democrat or a Republican. I've been registered as each at various points in time, but I'm currently much more of an independent. I do think that the current tax system is not fair, but just want to give you my background so you sort of know where I'm coming from. And as we'll see, I don't think this is a party issue. This is not a blue versus red issue. I'm also a U.S. citizen, which means I have to pay U.S. taxes on all of my worldwide income. I do pay my taxes, I follow all the tax laws, and I like doing this because that way you know that the money that's left over is really yours. None of this is tax advice. I'm not a tax advisor. I, in fact, use a CPA to do my taxes, and you should know that the IRS, ignorance of the law, is no excuse for the IRS. So if you try something and it doesn't work and the IRS catches, you can just say, well, I didn't know that's how it worked. It doesn't matter. You'll be in trouble. You have to pay taxes and penalties. So please, don't consider any of this to be tax advice, and be sure to consult your own tax advisor. Now, I would say that I try to minimize how much I pay in taxes, completely legally, of course. I have to say also, I'd be happy to pay more in taxes if our government wasn't so wasteful. Here's just a list of 50 examples of government waste. A couple of them really jumped out at me. The SEC, the Securities and Exchange Commission, recently spent $4 million rearranging desks and off at its office in Washington, D.C. And here's another example. I don't want to use this word that's used right here. You can probably see it. Washington will spend $2.6 million training, shall we say, Chinese women of the night to drink more responsibly on the job. Everyone has their own list of sort of crazy things like this. As I said, I don't think this is a Republican versus Democrat issue. If you look at the 15 richest Americans, the first 9, as far as I can tell, starting with Jeff Bezos and Bill Gates, seem to be Democrats. Warren Buffett is certainly a Democrat. All these people in Silicon Valley tend to vote Democrat, or at least support Democrat candidates or causes. The names that really jump out at me as being Republicans are the Walton family, obviously Walmart, and also the Koch family, who've been known to be big backers of a Republican Party. So I often hear people say the Republican Party is the party of rich people. Well, it's actually both parties. And the really rich people in the U.S. actually tend to vote Democrat. And then you have people like Michael Bloomberg, who switches back and forth between parties. He was a lifelong Democrat. Then he became a Republican when he wanted to run for mayor of New York. And then he was independent, and now he registered as a Democrat again when he was competing to be the Democratic nominee. So I'll just say you can make comments in the comment section below, but I don't think this is a red versus blue issue. I think that the United States is currently run by the wealthy for the wealthy, and that they are part of both parties. And we can see here, here's an example of the Walmart heirs. It looks like they're voting a little more Democrat than Republican. So obviously this is fluid and people are flexible. And in fact, last thing I wanted to point out before we actually talk about how to avoid paying taxes is that one of the biggest tax breaks that's really used very widely in Silicon Valley, QSBS, the Qualified Small Business Stock Program, also known as Section 1202, this was actually signed by President Obama. Now, the main way that rich people avoid paying taxes is they hire very expensive tax planning attorneys and other people. And this makes a lot of sense, obviously, if you have the money to spend $500,000 a year paying for tax advice and setting up very sophisticated tax structures, and you can save $10 million, you'll do that all day long. Even if you can just save $500,000 and $500,001, it might make sense. So this is what I'm going to be showing you is sort of things that I know about, but I'm not a tax guy. If you have a lot of money, it makes a lot of sense to hire someone who's sort of on the cutting edge of how to avoid paying taxes. So let's talk about some very concrete strategies that most of us can use. So a Roth IRA is a great one. a Roth IRA is similar to a typical individual retirement account, but what you do is you pay taxes on the money before you put it in. And so I don't believe you get a tax deduction for it. But then the money on the other end is tax-free if you withdraw it after the age of, so I want to say it's like 59 or something like that. But again, consult with a tax advisor. So this is a neat way of paying taxes first, investing the money that's left over, and then being able to take that out tax-free. So a lot of people have done this in Silicon Valley. Max Levchin, who was one of the early guys at PayPal, he did this, according to this article, with his Yelp shares. And when he sold his Yelp, he put there's about $10 million profit, at least as of 2010, and he'll never pay any taxes on that because he invested in Yelp through his Roth IRA. And here's the same article, a little lower down, says that Peter Thiel did the same thing for his PayPal shares. He bought shares when he first started the company. He bought shares for 30 cents a share. He held it in his Roth IRA. Again, I don't know if this is true. I'm just quoting this Forbes article. And then when eBay bought PayPal, he made, according to this article, $31 million completely tax-free. Now, this isn't a retirement account, and so theoretically you cannot withdraw it without penalties if you're less than 59 or whatever the age is. But what these Silicon Valley types do is they will borrow against their Roth IRA. And with interest rates being very low right now, they can basically get some portion of this. They can borrow against this. I'm not sure exactly how it works, but they can borrow at a very low interest rate and so have access to the money before they are old. Now, the big one we talked about, QSBS, this was the one that was passed. I believe the Congress was Republican and Obama signed it. This was a really, really big handout to Silicon Valley. What it basically allows you to do is to invest in a startup and not pay any taxes on your gains up to $10 million. Now, it's a little more complicated than that. You basically have to hold the stock for 5 years. You have to have invested in the company. When it was a very small company, it had 50 million or less of gross assets. It can't be like a financial company. It can't be some sort of shell company. But this is something that's been used by a lot of people to pay early on. You could sort of shelter 25 or 50%. But I think after 2015 or whenever this was passed, it became possible to shield 100%. So these are people who are making $10 million, paying zero taxes on it. And again, this isn't a Republican Democrat thing, but these are mostly Democrats doing this under a bill signed by Obama. Now, I have mixed feelings about this. It's great to encourage entrepreneurs to start new companies and to be rewarded. On the other hand, this is a tax break that's not really available to the common man or the common woman. And so I think it's one of these dirty little secrets that everyone knows about, but you won't hear politicians talking about that much. So that's QSBS. Another thing that millionaires and billionaires do is that they establish their residency in states that don't have an income tax. So in the U.S., we pay federal taxes to the federal government, and then some states also, in fact, most states, have state income taxes. The states that do not have an income tax are Alaska, Florida, Nevada, South Dakota, Texas, Wyoming, and Washington State, not Washington, D.C. The big tax haven states right now seem to be, at least for individuals, are Florida, because it's a nice place. It's got nice weather. Obviously Nevada, and then Texas. There have been a lot of Bay Area and Silicon Valley companies and founders who all of a sudden, when they're about to cash out of their stock, they decide that they would like to live in Texas, particularly Austin. And so they move to Texas, and the California authorities try to track them down to pay taxes. But if they're very smart, they can avoid it. They still have to pay federal taxes. But basically, if you use a combination of QSBS, you can shield that $10 million. And California does not recognize this. So what you do is you quickly move to Texas, which has a 0% state income tax, and that $10 million profit really is tax-free. There's an example of this. I'll just give you an example. Many of you may know Mark Sisson, who started this sort of paleo primal movement. He started a a Primal Foods company that was sold in 2018 for $200 million to Kraft Heinz. And then he used to live in Malibu. He was very famous for posting these pictures of himself on surfboards. But right before the sale happened, he moved from Malibu to Florida, presumably to, I don't want to attribute any motives to him. I don't know him personally. But this sort of fits the pattern of deciding you want to become a Florida resident when you owe a lot of taxes. So the state income tax in Florida is 0. The top bracket in California is something like 12 or 13%. So on $100 million, that's $12 or $13 million saved. Now, a lot of wealthy people choose to relocate to countries or places that don't have an income tax or have a very low capital gains tax. Like I said, if you're a U.S. citizen, you need to pay taxes, U.S. taxes, on all your worldwide income. So if you're an American who wants to do this, you're going to have to renounce your U.S. citizenship, which may or may not be a good idea. I personally like living in the U.S. But St. Bart's, there are a couple islands in the Caribbean like this. St. Bart's is famous for having no income tax. You have to have been a resident for 5 years. You have to make sure that St. Bart's is your domicile. You have to follow all these rules very carefully. But there's no income tax, and then the capital gains tax is a maximum of 25%. Now, the trade-off is that St. Bart's, I've heard, is a very expensive place to live. The real estate is extremely expensive because it's all rich people. And I imagine because it's an island, they have to bring in a lot of stuff, that the cost of living is very high. But above a certain net worth or certain income level, things like this make a lot of sense. And especially to the extent that U.S. tax treatment becomes more or less repressive over the years. Singapore's another famous one where their taxes taxes for residents again, start at 0%. The highest tax bracket is at 22% if you're making more than 320,000 Singapore dollars, it looks like, per year. And there's no capital gains tax or inheritance tax. And you're only taxed on the income that's earned within Singapore. So this is another place that's really been able to attract a lot of wealthy people by offering tax breaks. Then we have the really the elephant in the room, which is Amazon. It's a amazing company. I've obviously used them a lot, but I do have mixed feelings about them. This is an article from I can't remember what year. It's either, I believe it's 2019. Yeah, it is 2019. Amazon paid taxes. Their tax rate is 1.2% on $13 billion in profits, using lots of tax tricks. Obviously, they can afford very good tax lawyers. But here's an example of something that at least looks to me like an abuse of the tax system. And then it gets even worse because someone like Jeff Bezos can basically borrow against their stock. If you don't sell your stock, you never pay capital gains tax. Obviously, Bezos has sold some stock. In fact, he sold a lot of stock, probably billions of dollars worth. But if you borrow against your stock, and if you're really wealthy, you can get a very low interest rate. So here's an article by Scott Galloway where he talks about Bezos will not pay taxes. He'll borrow against his stock at 1 or 2% and not sell it. So he'll have the use of the money without selling it. So you have this really weird situation where you have a corporation that's not paying any taxes, essentially paying very, very low taxes, and then the wealthiest people in it are also not paying taxes. Again, I'm not a fan of the way the government spends its money, but regular people pay a lot in taxes, especially as a percentage of their income, and so this doesn't seem fair to me. Another article about Mark Zuckerberg a few years back taking out a mortgage on his Palo Alto house. It's like a $5 or $6 million house, taking out a 1% mortgage, and all this debate about why does he need to borrow money. Obviously, he doesn't want to sell more Facebook stock than he has to and pay capital gains. As a really wealthy person, he can get a very low mortgage rate. And in addition, if you can borrow money, let's say the inflation rate, at least the Fed's targeted inflation rate is 2%. If you can borrow money at less than 2% and you can hold the asset for a while, it's basically free money because you're going to be paying it back in depreciated dollars. So if you can ever borrow below 2%, and mainly only wealthy people can, but this is a great example of Zuckerberg doing it. This is one of the problems with the current system. On this channel, we've talked a lot about the central bank quantitative easing, which is basically just printing new money, buying treasuries, and keeping interest rates low by doing this. Quantitative easing benefits the rich who own real estate and own stocks, and it actually hurts everyone who's not rich. Here's another, this is a the famous 20% tax deduction that was passed a few years ago under Trump. This basically allows you, if you structure your business as an LLC, you can sort of exclude 20% of your business income. There's a lot of fine print here. I'm not going to go into it, but I will link to this. But if let's say your business is making $100,000, as I understand it, I'm not a tax guy, but your business is making $100,000 profit, you can take $20,000 away from that and not pay any taxes on it. Obviously, if your business is making $100 million, you've just saved $20 million in taxes. And as I understand it, a lot of real estate investments, obviously the Trump family does a lot of real estate, this is beneficial for the Trumps. As I imagine, QSBS was beneficial for many Democrats and Obama. Again, not a partisan thing, just telling you what's out there. Now here's something that everyone can use. After you own your own house, and if you still have money to invest, I really like investing in single family homes. And one of the reasons for this is there's this depreciation benefit that you get that helps to shield some income. So let's look at an example. Let's say you buy a rental house, and again, you have to have a certain amount of money to do this. This isn't for everyone, but it is definitely more in reach than some of the strategies we've been talking about. Let's say you buy a rental house that you want to rent out for $300,000. On your tax return, your CPA can do this. They'll break out, and I'm not sure exactly how they do it, but they'll break out the value of the land versus the value of the house. So let's say I pay $300,000 for a house, and my tax guy tells me the land is worth $25,000 and the house is worth $275,000. These obviously add up to $300,000. You use your purchase price when calculating this, I believe. Then what you do is you take the value of the house and you divide it by 27.50 years. And that gives you an annual depreciation number. So in this case, I made the numbers very round so they would work out. That gives you a budget of $10,000 annual depreciation that you can use to shield your income from the house. This is, again, completely legal, available to everyone. So let's say you're collecting $2,000 a month on this house. That's $24,000 a year. You can shield up to $10,000 of that. As I understand it, it's probably more complicated than this, but just looking at rough numbers. So instead of paying taxes on that $24,000 worth of income, you only pay taxes on $14,000 of that income. Obviously, you can deduct property taxes, you can deduct repairs, etc. There are other things that you can deduct. But by doing this, you've basically just shielded 42% of your rental income. This $10,000 is 42% of your rental income. So this is a tax break that's available to everyone. It turns out, if I remember correctly, you do need to add all these depreciation numbers back to your cost basis when it comes time to sell the property. But if you keep the property for the rest of your life, you can pass it on to your descendants. And I believe, I'm not totally sure about this, I believe you don't have to add it back then because of a cost basis loophole, which we're going to talk about. But either way, you shield a lot of your income while you're alive. And this allows you to perhaps take that extra $10,000 and after a few years, if this adds up, you can buy another house with it. So you can really compound your money with a bit of a tax break there. Now these are the 2020 tax brackets in the U.S. And basically we'll just look at single individuals. Basically the top bracket for single individuals is $518,000. Once you start making more than this, you're paying on your marginal income, you're paying the highest tax, the highest tax bracket, which is 37%. For married individuals filing joint returns, it's a little higher, $622,000. But it basically ranges from 10% up to 37%. Now there's some other taxes that can be added on top of this. But let's see. So this is basically like salary income, non-capital gains income. The top bracket is 37%. But if you look at capital gains rates, especially long-term capital gains, if you hold a stock or a house or an investment for a year and a day, so for more than 1 year, basically you can lock in this tax rate on your gains. So up to, if your income is $40,000 or below, you actually don't pay any taxes. If your income is up to between $40,000 and $441,000 for single filers, you only pay 15%. And then if you're in the really top bracket here, over $441,000 per year, you're only paying 20%. Versus we saw the top tax bracket for ordinary income, which would be salary income, interest income, etc., is at 37%. So really big tax savings there. And it does involve obviously holding a long-term investment. If you hold stock or real estate and you never sell it, you never owe any taxes on it. And this is something that Buffett has obviously done a really good job at. Now there is they call it the Obamacare tax or the net investment income surtax. So on top of this 20%, there can be an additional 3.8% if you meet certain income levels. Obviously, there can also be state income taxes on this, which is one reason that people relocate to Nevada or Florida or Washington State or somewhere like that. But this is a tax break that everyone can use. Long-term investments, this is one reason to try to hold on to your investments for as long as possible. I think Warren Buffett owns his Coke at about $2, if I remember correctly, something like $2 a share. He's making more than that on dividends per share, even though the stock is now worth, call it, I want to say $55 off the top of my head. And until he sells that, it's obviously within his company, but if you're an individual, until he sells that, he will never owe capital gains on this appreciation or this capital gain. Now, if you hold stock and never sell it, in the U.S. you can pass it on to your children using what's called the stepped-up basis, stepped-up cost basis loophole. So let's say that I bought many years ago, I bought Microsoft for $20 a share on a split-adjusted basis. Let's say it's now worth about $183 a share. If I sell it, I will owe the difference in taxes, probably at the 20% capital gains rate. I'll 183 minus 20 times the number of shares, basically. But if I die and then pass these Microsoft shares on to my children, again, this is a theoretical example. I don't own Microsoft right now. If I pass it on to my children, their new cost basis will be $183. So if they sell it after they get the shares after I die, they can sell it for $183 a share and pay zero capital gains. This is one way that wealthy people pass on their money to the next generation. This is the stepped up basis loophole, and it works no matter what your income level is. Above a certain net worth, there are estate taxes, but they kick in at fairly high levels. In the U.S. right now, it looks like it's about $5.3 million per individual or $10.6 million per couple. The vast majority of estates will never pay estate tax. But wealthy people do have ways to try to avoid this as well. You could move to a state that does not have a state income tax. So here is a map of the green states have estate taxes, the blue states have inheritance taxes, the yellow states have both, and then all these gray states have no state estate tax. But there still is a federal estate tax that people have to pay if they're passing on more than $10 million from a couple to their children. Now there is a device that wealthy people often use to avoid this. I know Zuckerberg's used it. It's called a Grantor retained annuity trust. These are fairly expensive to set up. I used to know how these work. I'm sort of unclear in the details, but basically, this article says it's going to allow them to transfer a total of at least $185 million in wealth to future offspring. This was published in 2012 when Facebook's stock price was much lower, so I imagine it's probably could be in the billions of dollars right now. But this is a way of avoiding estate taxes and passing on more money to your heirs. So I'll link to this Grantor Retained Annuity Trust, the GRAT. This is really something that won't apply to most people. But just want to give you an idea, and to summarize here, that there are lots of loopholes that the wealthy use. Fortunately, we can all use many of them. Take advantage of long-term capital gains tax. Try to invest in rentals if you can, and use that depreciation shield. And also try to hold your assets in a Roth IRA if possible. Let me know your questions and comments. Please hit that subscribe button if you haven't done so already and you found this video helpful. And also let me know if you have any ideas what you'd like me to make my next video about. Thanks a lot for listening, and I'll see you in the next video.